So today we have a very special guest. Her name's Amanda Hahn. She's a real estate tax expert, investor, and she is actually was it the author of Tax Savvy Tax Invest? What's the name of it? I keep forgetting. I have the book out right now.
The book is called Tax Strategies for the Savvy Real Estate Investor. It's such a long title.
Yeah. Hey, it works though.
What's the other
Yeah.
one?
The book on advanced tax strategies. Yeah.
That's awesome.
Okay, so like, what kind of how did you kind of get in real estate? Decide to get in this real estate like tax kind of thing. You just get really mad at the tax system and say, "Hey, I'm going to go become an expert." So, how does someone kind of like decide, like, "Oh, I want to become a real estate tax professional"?
Yeah. Oh my gosh, that's such a great question. I like that. But no, it's not as exciting of a story as I got mad at the IRS or anything. Um, you know, my Yeah, my mom is actually an accountant. So growing up, she always had told me, it's kind of a stable job. And so, I went to school to be an accountant. I actually started my career at one of the big four accounting firms internationally. And I happened to end up in the real estate specialty group. So I worked for the first couple of years. I worked on a lot of mostly real estate clients, and it was just kind of a job. I think with any job out of college, I didn't really think too much of it until I read Robert Kiyosaki's book, Rich Dad Poor Dad. And, he talks a lot about tax savings and real estate and business. And I started to look at my work a little bit differently and just really realizing how my clients were making so much money in real estate and hardly paying any taxes. And that's when my husband and I decided, hey, we should get into, real estate investing because we already know the tax side of it. So kind of
Yeah,
just that's the way it happened in the reverse. Like we were already doing taxes for real estate and said, hey, maybe that's something we should do ourselves.
yeah, I can see that. I can see like, okay, well, they're paying like 0 to no% tax. Like, how can I do that? But
Exactly.
so it's kind of that's kind of how you got in to the tax world was through your mom, and more or less she like inspired you to like second generation tax expert.
Yeah, yeah. And it's really interesting because my parents invested in real estate and my grandparents invested in real estate. So growing up, I was around real estate as well. I remember as a little kid, I would help my grandparents to do like tenant turnovers. My cousins and I would go and paint the walls, and it was a ton of fun. But I just, I never, growing up initially, never thought it's something I would do, like that I would invest in real estate until, later on where I kind of put the two to two together and saying, hey, that's something that I can do as well, right?
So I mean, you have a unique experience to see how valuable real estate is. What are some of the advantages that comes to buying real estate? Like you said, you like, okay, well, I buy real estate because hey, I know the tax side. What's some of the tax advantages for that?
Yeah, I mean, there's so many, tax advantages. I think it would probably take us days to talk about all of those, and probably we'll cover a lot of those, today. But just I mean, the ability to outside of taxes, just the ability to use leverage, right, and
Mhm.
creating cash flow and just kind of have money working for you was really what drawn me into kind of on the investment side. But tax wise,
Mhm.
I mean, as a regular kind of a W-2 worker, at the time I was very limited in terms of what I can write off. It was pretty much nothing
Yeah.
besides my maybe like my primary home and some donations to charities and stuff. But once you become a real estate investor, you're really kind of like a business owner. And when you hear about people talk and say, oh, when you're a business owner, the IRS gives you so many incentives and tax breaks, a lot of that really translates very well when you become a real estate investor. And, depreciation and the ability to just kind of defer taxes through, various parts of the tax code. So there's so many benefits tax wise when it comes to real estate investing.
Yeah. So I think one of the when I was reading your I think it was the first book, you were talking about like creative ways to like write off vacation and travel and stuff like that. Can you explain like how you kind of do that? Because
Yeah.
like we're being a real estate investor, you think if you're going to look at real estate. mean, technically that's a business expense. So can you kind of explain how to kind
Mhm.
of do that? So I don't kind
Yeah,
of get in
yeah.
situations where I feel like fun.
Well, okay, we'll talk about the right and the wrong ways to do it, right? Because we want to make sure people have all of the accurate information.
Yeah, because there's a lot of
Um,
misinformation out there for
Yeah.
sure.
so
Well,
we'll start with the wrong way first. So a lot of people sometimes think, hey, I'm going on a trip to Hawaii with my kids for the summer. And so if I'm there, let me just pick up a couple flyers here and there, and therefore, I'm going to kind of write off the whole trip. It's unfortunately not as easy as that. What you want to do is to plan ahead strategically, and we'll probably use this word a lot today. Planning ahead, because when it comes to taxes, it's all about planning. And so the right way to do is to say, okay, if let's say we're going to go to Florida, right? I'm interested in maybe investing in Florida. It's a hot market. And so what you want to do is you want to make your contacts in Florida prior to leaving for the trip or booking the trip.
Yeah.
So that means getting in touch with someone locally, an investor, a realtor, a broker, lenders, right? And kind of scheduling those types of appointments ahead of time. And so when you do that, what you're doing is you're creating the facts that, hey, the reason I'm going to Florida in a couple months or a couple weeks is because I have these predetermined business meetings or activities, right? And well, guess what? In that area, maybe there's also Disney World or just other fun things that I might want to do or enjoy. And that's perfectly fine. There's nothing that says you have to be doing business or real estate 24 hours a day, right? So you can have some fun in there. But the key is that the reason you're going first and foremost is for real estate and real estate investments. And that's what helps you to substantiate that, the flight and, maybe part or all of the hotels and the rental cars and all that may be tax deductible.
so you have to keep those things separate. Like if you took 4 kids, you could only write off yourself. Is that correct? Your ticket,
Yeah.
your
For the most part, assuming too that your kids are younger and not really, part of the business. Of course, if you have older kids who are investing together with you in the real estate, then that's a possibility to have everybody write those off. So it kind of just depends on, what are the kids' roles with respect to that particular investment. But yeah, if you and a spouse are going there looking at real estate, then that's at least your tickets, right? And if your kids are young, I'm assuming they're probably in the same hotel room as you. So
right,
writing
Yeah.
off the hotel room is kind of, part for the family. But the
right,
key is really to plan ahead prior to leaving for the trip or prior to purchasing the tickets even. And so you can show that, hey, the reason I'm going to Florida primarily is for my real estate investing. And that really could add up. If a trip costs you in total $1,000 or $2,000, you're at a 40, if $1,000 you're at 40-50% tax rate, that's a pretty significant, actual cash
Yeah.
savings, right?
Yep, that is. Now, when you set this up, when you're a W-9 employee or W-2
W-2.
employee,
Mhm.
yeah, W-2, and then you set up this real estate investment firm. Do you set up like what do you suggest to people? Set that up as an LLC, and then you have your W-2. Is that how you structure it?
That is such a great question because I get that all the time. And that's actually a big misconception from real estate investors. And I say that because, what I was just talking about is you're in the business of real estate, right? And for investors, the business of real estate simply means you are someone who is investing in real estate. So that means you are, you're buying rental properties or you're doing flips or wholesales, whatever it happens to be. That part doesn't really matter as much. Now, regardless of whether you have a legal entity like an LLC or a corporation, that does not limit your ability to take tax deductions, right? So if I'm someone who, my first rental property, I'm just going to buy it in my personal name because of financing reasons or whatnot, I could still write off those things because I am in the business of real estate. So it doesn't matter as much whether I have an LLC or not. As long as I am investing in real estate, those expenses should be tax deductible against the rental income, right? So,
So, at what point do you want to get an LLC?
yeah, if we're talking about rental investors, There's really not a specific point because it doesn't really matter for tax purposes. Because we just talked about, right? Regardless of whether you have an LLC or not, you can always write off those business related expenses like travel, or even, if we're not talking about vacation, even traveling locally, where you're just driving your car around, the mileage and, all those car expenses, or if you're working from home with your home office, you can always write those off regardless of whether you have an LLC or not. So, whether you have one rental or 100 rentals, doesn't matter. We can always write off those same things. So, when to have an LLC really for rental investors is really a conversation with an asset protection attorney, because
Yeah.
the only reason you have the LLC is for liability protection. And so, your attorney might say, hey, the equity is not a lot in the property, so maybe you can put, two or three together before you have an LLC. Or they might say, hey, this was an all cash deal, and I think it makes sense for you to put it in an LLC. It is a little bit different when we're talking about investors who are doing other types of real estate investment, maybe doing flips or wholesales. So those types of investors, I typically recommend having an LLC or an S corp earlier on, maybe even before you buy or sell the first property, because there are definitely tax savings if you were to do that sort of active investment, on the real estate side.
Okay, thank you.
So more of a kind of a personal question. So I recently just had a daughter, and I've read in your book that you said you can find ways to write off your children. So I really need to know that.
I love when the podcast turned into personal questions. Well, first off, congratulations on your daughter. It's such an exciting time. So, yeah, when it comes to taxes, the IRS doesn't really have an age requirement, okay, per se, in terms
Mhm.
of when you can, at what age you can pay someone. Okay.
Yeah.
So, if you've seen like the, diaper commercials, I mean, clearly there are, kids who are paid for different tasks that they perform. Now, realistically, what the IRS does require is that the compensation that you pay to your kids, or it doesn't have to be kids, but kids, mom, whoever you're paying, it does have to be reasonable in relation to the work that they are doing for you. And so, what oftentimes that translates to is if you have a 6 months old or a 1 year old or even a 3 year old, you probably can't be paying them a ton of money, because it's difficult to argue that they're your like IT consultant or something like that, right? When they get a little bit older, in the tweens and teens, nowadays they probably know a lot more about technology than we do. But so the older they are, the easier it is to pay them, maybe like 10,000 or more per year if they're doing a lot more of the work based on capability. For the younger kids, again, it's not to say you cannot pay them. It's just a matter of figuring out what can you pay them for. And so for little, babies like that, oftentimes it's going to be for, kind of like royalties and things like that for having their image in your marketing and things like that. Now, I know you guys have your, all the products, right, that you sell. So that might be something more where, if incorporating their image and those kind of marketing pieces and figure out what is a reasonable compensation for something like that.
And how much can you pay them for a year?
There's
Your
no dollar amount, right? For the IRS, there is no limit in terms of the dollar amount. It's completely based on what is it that they're doing for you, how many hours they're working, and what is the average compensation. So if you have an older child who's 16, 17, and they are helping you with social media marketing, right? Then the next step is to say, okay, well, if I didn't pay my child for social media marketing and I pay someone else to do it, what is an hourly rate for that? Is it 15? Is it 14, whatever the hourly rate is, and then have them track their hours, and then you can see how much to pay them. I mean, we have clients who have older kids who are paid, more than 20, 30,000 a year because they're doing a ton of work in their real estate, right? So there's not a cap per se in terms of how much you pay. It all comes down to reasonableness and what they're actually doing for your real estate.
isn't there a maximum you can pay them that's going to be tax free? I
Oh
mean,
yeah. So yes. Yeah. So in terms of like if you don't want to have them pay any income taxes currently, and that changes every year, currently it's around $12,000. So the first $12,000 of income in a W-2, as an example, they don't have to pay income taxes on. Yeah.
And that's
But
pretty
yeah, but I wouldn't, it kind of everyone's situation is a little bit different. I wouldn't limit someone based on that. So we have clients who maybe themselves are at, 30% tax rate or above, right? And so for the kids, even if they paid them over the 12,000, the kids might be paying 10% tax while the parents are saving 30% tax. It's still a pretty significant tax savings, even if you go beyond whatever is just the amount that they don't have to pay income taxes on.
So I think one of the main questions, like even when I got into real estate, being an agent, is how do you write? Like, what's the best way to maximize your home office space?
Yeah, that's a great question. And, home office, I think, unfortunately, we're still hearing a lot of people who say that their CPA is telling them not to write it off because it's an audit flag. And that's
Yeah.
actually something that's, may have been true decades and decades ago, but the IRS has actually made it, easier for people to take home office deductions. So the best way to write off your home office is to create the biggest space possible for your home office. And the reason I say that is because for home office, one of the ways you can use to calculate it is based on square footage percentage. And so if we're saying, okay, if your office space is 30% of your entire home versus 10% of your entire home square footage wise, then you're going to get a much bigger tax deduction, right? If it's 30% of your total house. So, if you got several different areas or spaces, if you have like a loft, usually that's, a fairly big space, that might be a little bit better than a small bedroom. Or if you have a basement, that's going to be your home office where you're using it, clients will come visit you. Oftentimes that's a pretty big percentage in relation to the house itself, where you might be able to write off a much larger dollar amount every year.
What about the living room? What if what if that's consider that one off?
That's a good question. So there has been a lot. I mean, I don't say a lot, but historically, that there have been many audits where the IRS have disallowed the main living spaces, and those are kitchen and living room. And we have, sometimes we come across investors who say, I have a dining room, I don't use it, right? I don't eat there. I'm by myself. I never eat there. That is where I work from, 99% of the time. Unfortunately, the IRS has always won the argument that there has to be at least one time where you have used that dining room to eat off of. And therefore, that cannot qualify under the exclusive use rule because the home office is supposed to be exclusively used for business, not like a part-time nursery, part-time office. Right. So that's where the whole concept of living room and dining room becomes a very tricky path to go down because I think it's very difficult to prove that that's exclusive business use.
because I used to hear stories like you had to have a door from the outside directly into the room, um,
Hmm.
and all kinds of things about why not to write off your home office. So as long as it's just dedicated to that and you use
Yeah.
it consistently, you're good. And I'm sure it's gotten more since COVID with everybody
Oh, for
staying home.
sure. Yeah, exactly. And so that's, I think, like I said, several years ago, the IRS had made it easier to claim a home office deduction, where you can actually just use the standard, dollar amount per square foot rather than like tracking your expenses and things like that. But yes, I've also heard many years ago where CPAs were telling people that you have to have, a separate entrance and all that. So none of that is true. You don't even have to have a door to your home office. It could just be part of a space. So, what I mean by that is like you can't just say my whole living room is my home office, right? But if you have, an area in your living room that's somewhat sectioned off where the desk and, that area is only for business, but here's the other side where it's your couch and TV and all that, the portion that is used for your real estate, right? The square footage of that section could certainly be your home office. We have people who use like the end of a hallway, right? If they have limited space, the end of the hallway is where their desk and all those things are. And so that section could be a home office as well. And then, we mentioned the loft earlier, right? So if you have a loft space, a lot of those don't have doors. That certainly could be a home office if it's used. It just can't be like a multi-use. And the example I always use is like, oh, this is my home office plus it's also a guest bedroom when people visit. Those are times when you'll get into trouble because
Yeah.
then that's not exclusive because your friends are kind of hanging out there if they come over to sleep.
So I guess like what everyone's scared about, definitely taxes, and probably the real reason why no one does a lot of home offices is everyone's scared to get like IRS audited because they're going to think they're going to go to prison. So what's some ways to like really protect yourself from the IRS? Because I think I read your book and they said like you're guilty till proven innocent. That's almost like a losing battle.
Yeah, it's funny. I know. One day I thought about that term and I was like, oh, I think that's a good way to describe taxes. So basically, from the perspective of like, hey, you said you spent $5,000 on something for real estate, you have to be able to prove to me that you spent it, right? I mean, not to me, but to the IRS. And
Yeah.
so, but yeah, I will say the whole scare tactic that people have used decades ago about home office, not so concerned with that. In the past for our clients who have invested in, real estate, who've gone through audits, I personally really never had anyone question the home office itself. Because if you think about it, for most investors, especially those who are landlords, right, investing just in rental properties, most people don't go out and rent or lease an office space to manage their rentals. I mean, as a realtor or broker, sure, a lot of people, lease an office space to meet with clients, but as a landlord, very few people do. And so I don't think it's uncommon to be claiming a home office. So not super concerned. Now, you do want to make sure you can document the actual office space. So it's taking a picture of the office itself, just be able to show kind of, what that looks like in case you're questioned. I think, beyond that, there's really not too much to it. But, just in terms of like expenses in general, right? Because we were mentioning the guilty until proven innocent, that applies to most types of real estate expenses. And so going back to this whole topic of making sure we maximize the tax write-off for our vacation as an example, vacation property, vacation to look at properties as an example, making sure you keep copies of the receipts, the emails that you've had with local realtors and things like that to be able to prove, hey, the reason I went was for these real estate business activities I've prearranged.
So almost like pre-plan your argument just in case you get in a situation where you have to explain yourself to the IRS. Well, I'll pre-plan this. Pre-plan you
Yeah.
explaining yourself to the IRS. Sounds like.
Yes, and that, really is such an important part of of saving taxes is the planning, because I think that still the majority of real estate investors and just taxpayers in general, right? What we do is we say, okay, the year is gone. I'm going to get all my receipts, sit down with my tax person, and then say, here, help me save taxes. But at that point in time, everything's already said and done for last year, right? You can no
Yeah.
longer pay your kids last year. You can no longer pre-plan for your vacation because you already went on it. And so really the right way to save on taxes with anything you do is to plan ahead. And so that just means, like when you read the book we wrote, it's all about making sure that you know ahead of time what you should do, how you should do it before doing it, so that you're creating the facts so that by tax time, your tax person can file the optimal tax return for you, right? You can be able to show him, hey, I went on this, I went to Florida and here are all the business things I did to prove that those were legitimate business expenses prior to actually going.
Oh, okay.
So, what are the most common tax write-offs you think that people miss?
There's so many. I think investors are really good at capturing, the usual stuff like interest and taxes and
Right.
management fees and repairs. Right? People are really good at that. What a lot of investors still miss out on are what we consider the overhead things, the non-property specific items. So, and we talked about a couple of them already, right? Home office, travel, personal use of a car, cell phone, laptops. If you're going to Costco to buy stamps or paper, coffee for the home office. So a lot of those things, and even like buying books, right? Education stuff, buying a book about real estate investing or taxes, or going to a local real estate meetup, going with another investor to have coffee or talk about real estate. So a lot of those things we see missed time and time again. And even, for investors that we've been working with for a whole year, and then when it's time to do their tax return, I'll be like, hey, what about this? I remember I saw you at that conference. Where is the travel cost for that? So, I think the best practice to get into as an investor is to make that part of your habit. Okay. What I mean by that is, when you go out, before you spend money on something, ask yourself, right? Is this something that's reasonable and necessary for my real estate business? Does this help me in my real estate business? And if so, keep the receipts, track those expenses. The worst that could happen is at tax time, when you meet with your tax advisor, they say, oh, no, that's a stretch. You cannot write it off. Right. But at least you've done your part to try to at least capture it. Because if you don't capture that expense, your tax person never sees it, it's automatically not written off, right? Because they're not with you every day when you're spending that money.
Yeah.
So it's good kind of a practice to ask yourself those questions.
Well, clarify about meals, because I know that kind of changes, every so often. So I know that meals, you can't, if you're just going out to eat with somebody, but you're talking real estate or it's a networking group, can that be written off?
Yeah,
Even though it's just
definitely.
one meal? Okay.
Yeah.
But no alcohol, right? You can't write off drinks.
No, there's nothing that says you can't write off alcohol. There's a couple different things. So for business meals, you can write those off as long as you can show that business occurred either right before the meal, during the meal, or right after the meal. So, example, maybe you go to a real estate meetup and then right afterwards you have meal or drinks with other investors who are there to network and, do deals and things like that. You could certainly write off those meals because business occurred right before that, or even during, right? Even during the meal, you're probably still talking about real estate. So those certainly could be tax deductible. Actually, in this year in 2021, so normally meals are 50% tax deductible. And what that means is if you spend $50 on a meal, your deduction is actually $25. This year, though, in an effort to help, I think, the restaurant industry, there has been a change in the tax code temporarily, where if you have a business meal from a restaurant, then it actually is 100% tax deductible. Yeah, yeah. And it doesn't, so yeah, it doesn't necessarily mean you have to eat inside the restaurant. Okay, it could be ordered from a restaurant and it could still be tax deductible. So if you just like, hey, I'm having a party at my house for real estate, and I'm going to bring in the meal, but it's ordered from a restaurant, that also could potentially be 100% tax deductible as well. The thing you're trying to stay away from for meals, what I hear most often is like, my spouse and I talk about real estate all the time. Every meal, we're always talking real estate. So can I just write off every single meal? And that's, I think, when you'll get into trouble, because I think it would be hard to prove on an audit that every single meal really had business purpose. So, again, business purpose meaning, we had a business reason to be here, and then we had a meal, as a result, and not we were eating and we happened to talk about real estate. That's not a business meal.
But you can't count the tip, correct? Can you count the tips as
Um,
well?
yeah, I mean, I've really not seen an auditor get into the nitty gritty of, tax and tips and things like that. So yes, generally I would say, yeah, you can count the tip, because the whole notion is the reason for this meal was because of the business activity, right? So
Right.
whether it's the food or the drink or the tax or the tip, it's all part of the reason why I'm here. Yeah, but good question.
I have a question. So I had when I was reading your book, one of the main things like I've never really heard of was like how you used retirement plans to really help fund your real estate deals. Can you kind of explain that for everyone, including myself?
Yeah, of course, of course. So the concept is called self-directed investing. Okay, most investors, when we hear about or talk about IRAs and 401ks, we typically think about the stock market, right? And so I often have
Yeah.
clients who tell me, because most of our clients are real estate investors, I often have people tell me, I don't want to fund my 401k or I don't want to fund my IRA because I want to keep the cash for real estate. And thankfully, there's a solution around that, which is called self directed investing. And so, self directed investing just means that the money is still in an IRA or 401k, but instead of having it with a traditional brokerage account like Fidelity or Schwab or Bank of America, it is with a self directed custodian. And so, when you put your IRA or 401k money into a self-directed IRA or a self-directed 401k, then you're no longer limited to stocks, bonds, and mutual funds. Then your retirement account can actually go out and buy real estate instead. And this is something that's been allowed by the IRS for, gosh, decades. But you don't really hear that advertised as much. And the reason is because the financial brokerage firms want your money, right? They want that money in stocks. That's how they make money. And so there's not a lot of advertisement or public education about the fact that, hey, IRS says you can use your money to invest in other things outside of the stock market. Now, we talk about real estate mainly because we're real estate investors. You guys are. I mean, our audience is real estate. But just to be clear, in a self-directed investing environment, you're not limited to real estate, right? You could certainly buy a property on Main Street, or you can be a note investor. So let's say that Tyler has a rental property, needs money. My IRA or 401k could be a lender to your property. Or just outside of real estate in general, my IRA could invest in like a startup business. If my cousin is starting a new tech company or he had the greatest new invention, my retirement account can also invest in something like that as well, potentially. So there's a lot of different things you can invest in outside of just the stock market.
So exactly how would you do that? See, I have a fund with American funds. So how would
Yeah,
I do that? Who do
yeah,
you
that is
call?
that's a great question. So, the first step is to look at the money, right? So, where is our money? If you already have an IRA or 401k, right? Let's say you have money already with the IRA or a 401k money from an old employer that you've quit, working there a couple years ago. So, what you can do, first step is you interview and decide who you're going to use as your self-directed custodian. And there's so many of them out there nowadays. So, basically, you find out who you want to be your self-directed custodian. And once you decide, you go to them and you open up your self directed account with them, right? So we'll open up a self directed account. And then once that account is open, the next step is they will have paperwork for you to transfer money, right? So let's say you go to Direct IRA, right? That's one of the self-directed custodians. You fill out their paperwork, you open an account, and then one of the paperwork is going to say, hey, do you want to move money over to us? And you say yes. And that money, you'll give them the account number of where your current retirement money is at. So let's say it's at Fidelity, right? So what will happen is the self-directed custodian will directly request money from Fidelity, and that will now be moved over to your self-directed account. Okay, so that part is fairly simple. You basically tell them, hey, my money's over there, go get it. Once it's in your self-directed account, you basically can start shopping. Okay, so shopping for assets, right? Not for shoes, shopping for assets. So you start shopping for assets, you go out and start looking for real estate. And when you find a property that you like, as an example, instead of you making an offer on the property, right? Kim's not making an offer. Kim's IRA is going to go out and make an offer. And there's, the custodian has all that paperwork for you. So be Kim's IRA making an offer on Main Street. And then, your IRA money will fund the deal. And when the property closes, it will close in the name of your IRA.
So what about like I think you previously just said a couple minutes ago, you have to be done with that previous employer, like you said, or can you be currently working and they're currently
Yeah. Yeah, so it depends. That's a great question. Now, if you've separated from your old employer, odds are you have 100% control of that money. So it's a easy, just kind of move it over. If you have an employer and your money is tied up in their 401k account, what you need to do is you need to find out from the plan administrator. Okay, and again, that would be Fidelity or Bank of America, whoever's custodying that money, and you ask them if the plan allows for an in-service rollover. Okay. An in-service rollover just means I'm still working here, but I want to roll my money out of this plan into a different account. Some employer plans allow for it, some plans prohibit it. And that's why you need to find out from your plan whether they allow it or if they don't allow it. The IRS doesn't have restrictions. If they
If they
don't
don't
allow
allow
it, yeah, it just means that you have to keep that money there with them in the stock market or whatever they're offering you
yeah.
until you leave that employment. But once you leave that employment, the vast majority of the time, that money becomes yours and you can choose whether you want to take it to a self-directed or, roll it into some other vehicle.
So when you're searching for yourself, you said it was self-directed provider.
Mhm.
What'd you call them?
Self-directed custodian.
Self. When you're looking
Yeah.
for one, what do you want? What is there anything that you want to kind of be leery of or kind of looking for?
They all do the same thing, in my opinion. I'm sure when you talk to them, they'll say they do something slightly different. So really, what we always advise investors is you're trying to figure out what are their fee structures and what added things do they provide. So a lot of custodians will help you with issuing tax paperwork. Like if you took out money and things like that, they'll help with that. I think the vast majority of them do that. Some custodians charge based on transactions, meaning every time you buy or sell a property, there's a transaction involved, a transaction fee. Those are fairly minimal. But it does add up if you're like buying and selling a lot of real estate, right? But if you're just like a long-term hold investor, those are usually fairly minimal. Some custodians charge based on the asset value of how much your assets are worth within the retirement account. So really, as an investor, those are the things you're trying to weigh, one person versus another. And just like with anything, custodians are sometimes they're bigger companies where you call 1-800 number and you can always reach someone, but it might be different people. Or you might have a smaller company where there's, you might not find them 24 hours a day, but at least you're always talking to Mary every time you call. And Mary knows who you are, knows your situation. So those are the kind of things is, in working with a custodian, like what's your preference?
Can you take money out of a tax sheltered account? If you
What's
have
an example that you're looking at for tax sheltered account?
well, if you had a tax sheltered account that you had, and it's taxed, when you get older or whatever you want to
Hmm.
take it out, can you
Hmm.
still
Hmm.
roll that into a custodian account?
Yeah, it just depends on what type of tax shelter. If you're talking about like another IRA or a 401k or a pension plan, then yes, oftentimes you can roll those into self-directed accounts. And they're just kind of mirror images. Like if you have an IRA, a regular IRA, there's a self-directed IRA. If you have a 401k, there's a self-directed 401k, right? So all of those are the same. And it's exactly the same, except, your regular retirement tax sheltered accounts versus a self-directed account, they're exactly the same. The only difference is normal retirement accounts are held under brokerage firms. That's why you only hear about stocks, bonds, and mutual funds. And those people, they give you a listing of what you can invest in, right? Large cap, small cap, and all those things. Versus
Yeah.
in a self-directed account, they don't give you a menu to choose from because you are in charge of what you want to invest in. So they don't give you a menu. You're going to tell them, I want a property on Main Street, or I want to lend to Tyler's deal, or I want to do my cousin's startup. And you're the one telling them what you invest in.
So there's no like certain rules like, hey, you can more or less invest in any kind of real estate in anyone's deal. There's not like a certain kind of rules that you have to guidelines you have to meet or anything.
Yeah, of course. No, of course, there's a lot of rules, and we can also that's also something we can talk for hours on. But the the rules, so at a general level, okay, the self-directed investing rules are that you cannot transact with yourself. And what I mean by that is your IRA cannot buy a rental you already own. Your IRA is not going to buy like your primary home, right? Your IRA is not going to sell to you. But anything that's regular with like an unrelated party, those are usually fine. You know, if it's someone else selling a home, your IRA can buy it. There's no issues with that. So, in addition to not transacting with yourself, you also cannot transact with your what they consider ascendants and descendants. In other words, your parents and grandparents or your kids and grandkids. So, meaning my IRA cannot buy from my kid or sell to my kid. My IRA cannot buy or sell to my parents or grandparents. And those are the people who also should not use the property. So I'm not going to buy a home and have my kids live in it in the IRA. It's going to be just
Yeah.
like a regular rental where buying from other people are renting.
I think one of the other things I read in your book is like I heard about self-directed IRAs, and I also heard of solo 401ks. What's the
Uh-huh.
difference between that and a normal 401k?
Yeah. So there's not really a difference in the solo K versus a regular 401k. The main difference in the solo K, it's self-directed. So you can invest in whatever you want. A regular 401k, typically your employer is has to do Fidelity and you're doing stocks, bonds, and mutual funds. So no real difference between solo K and the regular work 401k besides what you can invest in. The difference between IRA and 401k, there's a lot of differences. And for those people who are eligible for a solo 401k, we typically always recommend that. So a couple of the major differences, in an IRA, you're very limited in terms of how much money you can contribute into it every year, right? So you're going to do, roughly $6,000 per year, and that'll take you maybe several years to get enough money where you can buy real estate. In a solo K, if let's say you're a realtor and you make commissions income, right? If you make commissions income of $100,000 in a given year, you have a solo K, you might be able to fund $30,000 or more just in 1 year into the solo K and get a huge tax deduction for it. So comparatively speaking, IRA, we're talking about what, 6,000, and then in a 401k, you might be funding, upward of over 50, 57,000 per year could be the max. So it's just in terms of like how much more you can use to fund the solo K. The other great benefit of the solo K, and keep in mind, they're both, you can self-direct both, right? So it's just a matter of being able to put in more money in the solo K. The other great benefit of the solo K that we really like is that you can borrow from the solo 401k if you wanted to, tax-free, penalty-free. So meaning, sometimes we have clients who say, hey, that's great. I would love to put 50,000 into my solo K and take a tax write-off. But I just had a baby, right? And I kind of want the cash. I do need the cash for personal living expenses. I really can't part ways with it, all of that for a long time. And so what you can always do is you can borrow up to half of that money from your solo K. So basically half of that money comes back to you in the form of cash. And then that cash, you can do whatever you need with living expenses or, invest in other stuff. And so that's the benefit of the solo K that you don't get with like an IRA. So that's why it's just a flexibility, right? Not to say that you want to or have to borrow, but it's an option if you ever needed that for emergency purposes.
Is there any disadvantages? 'Cause, I've heard a lot of positives. Are there any disadvantages to for or solo 401ks and
Solo
self directed?
Ks, yeah, that's a great question. I've never been asked that. Um, I really can't think of. Yeah, I really can't think of any disadvantages of a solo K versus an IRA, um, besides the fact that the cost to set up a solo K might be a little bit more. The paperwork might be a little bit more burdensome than just a regular IRA. But outside of just kind of the paperwork side, and I think the fees a little bit higher, but nothing more than like a couple $100s to set up. So but outside of that, no, purely from a tax perspective, I really don't think there are downsides to having a solo K versus an IRA. Now, I will say that not everyone is eligible for a solo K. Okay, so maybe that's one thing to keep in mind. So, in order to have a solo 401k, you have to be someone with earned income outside of just like a regular W-2 or just rentals. So if you're, a realtor or a broker, you got 1099 income, great. Odds are you're eligible for a solo K. But if, you're working as a W-2 for Google, as an example, and you don't have any other active real estate, maybe you just work at Google and you own a rental property, then you're generally not eligible for a solo K because you don't have, a side job or side active business. So that is one, something to kind of keep an eye out for.
I know we're trying to probably get time to wrap up, but so can you go from an IRA to a solo K?
Yeah, certainly. So if, and we have a lot of people who do that, if they're a realtor and over the years they've funded an IRA or a SEP IRA and that's kind of built up. And today they're learning about this great perk of solo 401k. Sure, you can roll your IRA, SEP IRA, you can roll all that money into the solo K anytime you want. That's generally a tax-free transaction.
What about is there a way to like gift properties without actually like paying taxes? Like
Gift properties?
yes. Like say like you're basically you're trying to gift properties to I guess your son or daughter and you're retiring or just trying to gift
Mhm.
them. Just trying to avoid the I guess estate tax at the end, I guess.
Yeah. So, yeah, under current rule, and I'll preface this as when I say current rule, it's because there are a lot of proposals right now about changes in the estate and gift tax world. So we don't have any clarity yet on whether that will pass or, when it's going to pass. So we'll talk about today's, what the rule is today. For someone listening, I don't know, a year from now, it might be different. So currently, the estate, gift and estate tax lifetime exemption is roughly $11 million per person. So as a married couple, that's $22 million, and that means if you wanted to gift, those value of assets to the next generation, you don't have to worry about gift and estate taxes. And that's the vast majority of clients that we work with, right? Are that value or even a lot less. Um, so not really a concern, someone who's looking to gift an asset to their son or daughter, they can just kind of gift it. You file a gift tax return and that's it, right? Unless you go beyond that 11 or $22 million lifetime, that's when you kind of start needing more complex planning on ways to gift that over time. But currently we don't recommend actually people gift from parent to child, and the reason for that is because right now we have what's called step up basis, and what that means is, let's say mom bought a house for $100,000, right? And if mom were to keep that property and when she passes away that house is worth $1 million, the kids inherit that at $1 million basis, which means that if, the first $1 million that they sell for, the kids don't have to pay taxes on that either. And that's a huge benefit, right? Because that just means essentially no one pays the tax on that 900,000 of appreciation over the lifetime of the parents. And so what that means is, under current law, oftentimes it makes sense for especially elderly parents to keep the properties in their name so that when they pass away and when the kids do inherit the property, they get that and the kids don't have to pay taxes on it. Versus, in that same scenario, let's say the parents, bought it for 100,000 and they gifted it to the kids. What happens is when the kids sell, their basis is only that 100,000 that the parents paid for the property. So if they sold it for $1 million, now that child is going to have $900,000 of capital gains that they have to pay taxes on. Which is, something that you want to avoid, right? For when you're gifting things to kids. So that's the reason, right now, typically it's going to be the parents keeping that and then having the kids inherit the property so that as a family you're paying lower amount of taxes. But, again, if you're someone who's over the 11 million or 22 million net worth, then there's going to be some, a lot more advanced planning you want to do to avoid estate taxes in the future.
So, for knowing all the advantages for taxes, do you have any advice for new investors and what they should do to like prepare themselves, or what's something good to invest in starting out? Do you have any advice for them starting out?
Yeah, I think for newer investors, it's really important to make sure that you understand what are all the things that you can write off, right? As we were talking earlier about what people always track, just the property stuff, but making sure that you're tracking all of your real estate related expenses and just kind of asking yourself those questions. I think it makes sense to be proactive. I think a lot of people are afraid of CPAs and tax people and try to kind of avoid it at all costs until tax time. But really understanding that investing in real estate comes with so many benefits. And so it shouldn't be a thing where you're scared to talk to them. It should be something you're really excited to talk to them about. Because sometimes, buying your first property could end up saving you, 5, 10, 15, or even, 15,000 or more in taxes, right? Just in that first year. And so kind of changing the way you view that relationship, and your CPA really should be, an ally on your team, someone that you can call or email and talk to before you get into the transaction, to help you think about what are some of the things that you can do to make sure that you're maximizing your tax savings, because that basically adds to your return on investment, right? So if you buy a property this year, if it could save you 5, 10, $15,000 in taxes, that could easily be the down payment for your next property, right, in line for next year. So that really can help to supercharge someone's wealth building.
Yeah, I think that's what a lot of people are hesitant at the very beginning to get a CPA, because they're like, "Oh, well, it's expensive." I was like, "Well, it could be expensive, but how much money are they probably saving you through all
Yeah,
this?"
yeah.
I was like, "That, however how much like they're paying for you to do this, how much money are the your team members really saving you long term?" Is a lot.
Right,
I also
right.
think people get embarrassed because you are kind of embarrassed the way they keep their records or, getting started. They don't really know what they're doing. And I think sometimes it's intimidating when you go to professionals like you on the other side of the table.
Yeah, yeah. And I think yeah, that kind of carries out whether it's a newbie investor, because we've worked also with experienced investors too, who are just like, oh, by the way, I don't really have books and records, right? So it's not just a fear of the newbie. And, I think for us too, I think we always have people ask us like, oh, do you only work with very experienced investors or very high net worth individuals? What's like a yeah, is there like an income limit when I should start working with the CPA, whether it's us or anyone? And really, the answer might differ depending on which CPA you ask. But for us, we're not looking at the amount of income someone makes. I could meet someone who made $1 million a year, but might not be a good client for me because they're not really doing real estate. Or, they're just thinking about real estate, but they might not do it for a year or two. So in that scenario, there's very little, if anything, I could do to help them save taxes. Or we could be talking to someone who's totally new to real estate, just got their first property, but already have 2 or 3 under escrow, and they're ready to just blow out their real estate portfolio. And that was someone who could potentially get a huge tax savings, even if they're maybe not making a ton of money in real estate just yet, or not making a ton of money in their W 2. So I think it's more based on, how aggressively you're looking to grow real estate, that will kind of help translate into how much tax saving potential you actually have, and whether it makes sense to work with a tax person or not.
Do you help people through like all the states, or do you like? Because I know you're in California. Do you like get look into like certain state taxes for each person, or how does that work?
Yeah. Yeah, that's a great question. So, yeah, we do have clients all over the US. And I think, in fact, now more than half of our clients are outside of California. And so, yeah, we have clients who live in all different states, who invest in their own state or invest out of state as well. So, we have Florida clients that are investing in New York and South Carolina. We have California clients who are investing, also Florida and Tennessee. So, kind of all over. So, yeah, from the income tax perspective, when you're interviewing CPAs, whether that's us or someone else, you do want to make sure whether they're comfortable with multi-state, because for a lot of investors too, as their portfolio grows, they might not always be investing locally either. So you want a CPA who can kind of help you out as you grow that real estate too.
So kind of really wrap everything up. Where can people find you and find more about you?
I think the best place is probably our website, and that's www.keystonecpa.com. We have a lot of great information on there. We try to keep kind of the latest information, and last year and this year has been just so many tax changes because of COVID and things like that. So I think that's a great place to start. We'll have our recent podcasts on like this one today. We'll always showcase those there too. And we also have a free downloadable ebook. It's called 5 Cash Flow Strategies for Real Estate Investors, and specifically in talking about some of the ways to save on taxes, like income shifting to your kids and legal entity considerations and things like that. So yeah, those could be downloaded from our website as well.
Oh wow, I didn't know about that. I'll check that out. But I really appreciate you coming on here, and I've learned a lot, and it's been an honor to really meet you because I've been a fan.
I learned so much.
Yeah.
I know you're in front of someone like you, and you just want to keep on talking. It's like I really learned a lot. It's such a pleasure to have somebody your
Oh,
level.
thank you.
Yeah, because I
Yeah,
could have kept you all day, but I don't waste your time.
yes, thank you. Yeah, it's so much fun. I love talking. I have a passion. My husband and I, we really have a passion on doing education. That's the reason we wrote the book. We just felt, back then, I think there's not as many opportunities for, webinars and just talking to people out of state. You see people like at conferences and stuff, but we wrote the book because we said, hey, we really want to just be able to share some of the client success stories and nightmares, right, which you've read about in the book, and just really help spread the education, so that for people, even if they're not working with us, they can take those resources to their own CPAs, their own advisors, and kind of be able to save taxes. Because at the end of the day, these are things that are legally allowed by the government. They're government incentives. The government wants you to invest and grow, and so it's really important that we all take advantage of it. But I'm so glad I was here and happy to come back once there's tax changes and give you guys the latest.
We'd love to have you.
I do have one question. Where can people find your book at?
Oh, yeah. So our book, you can find it on Amazon. So just, Amazon.com. It's called Tax Strategies for the Savvy Real Estate Investor. And then the second book is the book on Advanced Tax Strategies for Real Estate Investors. And also, you can also find it on biggerpockets.com. Bigger Pockets is our publisher. If you buy through Bigger Pockets, I believe it costs a little bit more, but you get a bunch of freebies and perks and bonuses with that as well. So either place.
Okay. Yeah, I actually read your book, and when people were seeing that I was reading tax books, how are you doing that? I was like, and honestly, it was actually pretty good. Like reading, like when people saw like tax books, like, oh wow, it must be a bore. But actually,
Yeah.
I thought it was really good. So, but
And the reason that we wrote the book was my husband and I, we read a lot too, right? And so we're always reading tax books. And what I found myself falling asleep reading other people's tax books. And I just said, how can we expect investors to read it when I'm falling asleep? And that's my profession. That's my job. That's what I love to read and do. And so we said,
yeah,
we really wanted to write a book about tax strategies, but in the context of stories, like the short stories, like the chicken soup for the soul kind of stuff. And I think that's been well received. That it's not technical stuff. The book's not designed for CPAs. It's designed for the investors to read, so they can get ideas on what are some of the possible things that could be done to then have an impactful conversation with their CPA. Given those types of knowledge and scenarios. So
I think that's a wonderful idea.
yeah.